Hello investors, today is August 19th, 2016. I'm Grant, this is Gary, Adam Carlini is our third partner, and we are Dynamic Wealth Management. Hopefully everyone's having a good summer, hopefully everyone's enjoying watching the Olympics. United States is doing really well. Give you a quick update, United States has 103 medals in first place, China has 65 medals in second place, and Great Britain is in third place. So we're doing really well, it's been a lot of fun to watch that. But speaking of good performance, the market's done really well recently as well.
That's right, Grant. In fact, 3 of the 4 major U.S. indices, all-time highs again over the last week.
Wow.
So let's jump into the charts and take a look.
All right.
It is good to be with you. This is Gary Luna. I will start out with some of the charts and information. Again, just a reminder as to our activities that we have going on for the summer, because most of our folks are out of town. We were taking a break as far as our investments for breakfast and investment seminars, but the end of the summer is right around the corner, so we're going to jump back into those probably beginning of October is what we're thinking, but we'll update you on videos going forward. So let's start talking about what's going on in the market. As we mentioned in the intro, markets hitting all-time highs. So as you can see by our main risk indicator, that really drives our core ETF model, we are definitely still bullish. In fact, we have gone a little bit further into the green on the bullish side, which means that our allocation is more on the aggressive side depending on the client's risk profile, which we'll talk about a little bit more. But basically, we are more aggressive, and we have been now for some time. As we talk about some important things of the economy, probably the biggest thing that came out this past week was the release of the Fed minutes from their last meeting. And this is highlights as reported by EconoDay, which is a great website for all information that has to do with the economy. You can go out to econoday.com. So this is how they saw the minutes that were released and how they reported. And I'll just go through this first paragraph here. It says the economy was improving, but policymakers at the Federal Open Market Committee meeting in late July wanted to see more gains before raising rates. Yet the assessment of the core economy was upbeat, with household spending described as growing strongly, and the labor market following June's initial 287,000 surge in payrolls described as strengthening. Housing was seen as a modest positive, with the service sector expanding, but with the factory sector no better than mixed. So basically, the Fed, by their minutes, was not too concerned or quick to want to raise rates. So what happened with rates after that? Well, this is also a tool that you can see on the web. You can go to cmegroup.com, and basically this is the Fed Watch tool that we look at from time to time. And so probabilities of a rate increase at the next Fed meeting, which will take place September 21st of 2016, only 18% chance that they will raise short-term interest rates. So that's pretty darn low. The next meeting after that will be November 2nd. But at least for September, the markets are not pricing in a rate increase. So that was probably the key news for the week. I'll go ahead and turn it over to Grant and have him jump into the charts and talk about those all-time highs that we're excited about.
All right, thanks Gary. Let's jump into the stock market charts and talk about some of these all-time highs that we had recently. So first, let's look at the Dow 30. Here's the last year. You'll notice that it has been pretty volatile, but just recently we have got a new all-time high at 18,668. That was just about 4 days ago, and since then we're holding in there pretty flat, which is good. We haven't started to give it back yet. Just want to remind everybody, this 2016 started right here, and this was one of the worst starts to a year in stock market history. And all the stats were saying it was going to be a bad year, and actually it's been shaping up to the positive, which has been great. Here's the Dow since 1900. We just wanted to give you some long-term perspective here. it has really been a strong performer over the last 116 years. But there were a couple huge losses, right? So here was the Great Depression. Here was the dip of 2000, the dip of 2008. Here's a real flat period. It was from, the early 60s all the way into the early 80s. So what you really want is you want some kind of a model that can respond to these huge market crashes, but participate when the market is moving your way. And that's what our models attempt to do for our clients. Now, here's the NASDAQ, also an all-time high, 5271, which was really strong because actually the last high was all the way back to 2000. And I'll show you that here. So here was the previous all-time high, right? And that was back in the year 2000. And if you were an investor in the NASDAQ, you haven't had any kind of gain for 16 years. It took you 16 years to break even. So, and actually this drop here was an 80% loss. So if you had $100,000 in at the top, you would only have 20 at the bottom. That's how dramatic of a drop that was. So again, some process to participate in the upside, but a plan to avoid the downside. Here's the S&P 500. Again, all-time high, 2193. That was 4 days ago. Market's holding in there, so all positives, all good signs. Here's the S&P 500 since 1925. Same thing. Very volatile, but overall, in the long run, a great run. So participate in those upside moves. And the Russell 2000 has not yet hit an all-time high. So it has been trending and moving up very strong off this January dip, January and into February. But since mid-February on, it's actually been outperforming. It's very strong at this point. So we're interested in small caps here. Also, if you take the rest of the world and exclude the United States, it has not yet got back to its all-time high either. So the United States has been stronger as compared to the rest of the world. Okay, so year to date, let's show you some of the sectors here. U.S. stocks are up 8.3% year to date. Wow, there's a strong move in stocks considering we started the year 2016, started one of the worst stock market years ever with a huge drop to start. International developed stocks up 2.1%. International emerging markets has been very strong. That's a risk on sector there, so that's a good sign. Real estate is up 13%, very good. High yield bonds up 11%, almost 12%. Commodities up 13%, gold up 26%. Look at that. And treasuries up 7%. So that's short-term treasuries. Long-term treasuries up 16%. So year to date across the board looking really good as far as returns go. Let's jump into our allocations, and we want to talk about our new sector rotation model. We'll just mention that really quickly. Please contact us if you have more questions. But this is our ETF core model that we always show in these videos. You'll notice we are well above the yellow zone and above the red bearish zone. We are in the green zone, and we've been in the green zone for quite some time, and that's where we like to be, participating in the upside, but we have a plan for the downside. So what is our current allocation? It is risk on green, meaning that if you are a growth client, you're 100% in right now. No defensive holdings, all risk on holdings, all equities. If you're a moderate client, you're in an 80-20, 80% equities, 20% defensive. If you're conservative, you're 60-40. 60% risk on, 40% defensive. So we are green, and we are moving with the market at this point. Now, just a really quick introduction to our sector rotation model. We've been telling a lot of clients about this. We just rolled it out recently, 2 clients, but we've been working on it for a long time. You'll notice we have 16 sectors here. And what the model does is our first Our first criteria is that we don't want to hold any sectors that have fallen beneath their 6-month moving average. So if any of these sectors fall beneath their 6-month moving average, they become ineligible to us. And you'll notice these ones in gray, they're gray because they're beneath their 6-month moving averages. So now we know those are already excluded. Then we take and we rank them from 1 to 16 based on recent performance and volatility. And in our formula that we put together, it gives us a rank 1 through 16 and tells us which ones have the most opportunity right now. So we take the top 8. So in this model, as long as there's 8 good eligible sectors, we will hold 8 sectors. Now, when let's say in 2008, when there was a huge market crash, and probably all of these, except for 1 or 2, were probably ineligible because they were all beneath their 6-month moving averages. Well, then we wouldn't have 8 positions. We might only have 1 or 2, or maybe none, if kind of the whole market is crashing. And we would replace these positions with cash and treasuries and bonds, things that are going to be very, very defensive. So if the market does start to fall apart, you'll notice that a lot more of these will go gray and become ineligible to us. We only want to hold what's strong. We never want to hold what is lagging. So that's what we're doing in this model. We're trying to protect our clients and even outpace the market by holding the strength in the market and not holding the weak. So if you are interested in this, please give us a call. We'd be happy to talk to you more about it. Couple disclosures here at the end. We just want to make sure that you do not make any investment decisions based on this video alone. Please consult your financial advisor or financial professional before you make any financial decisions. We're not trying to sell anything or make any specific recommendations, just giving you a market update on what's happening out there. Thank you so much for watching our video. We will put out another video soon. Thanks for watching.